Borrowers should expect better times ahead as commercial banks begin to lower their lending rates this week after 4 months of loan rate hikes. Central bank figures show that interest rates jumped from an average of 15.5% in June this year to an average of 16.3% in September, as the 91-day Treasury bill rate shot up to 22% amid government's decision to borrow funds locally to meet budget gaps.
What became clear in terms of investors, as we now know, is that they began to believe that the government is desperate for money. So there was sort of insatiable appetite. And unfortunately, that sort of dynamism is what led to a substantial increase in the rates.
Equity Bank Group, which was among the banks that was slow at increasing interest rates, has withdrawn a notice to its borrowers increasing rates from 17% to 24%. That was to take effect on Thursday this week.
This was following the increase in Treasury bill rates to 22, and we realized all deposits were pricing towards 22, and we had to pass that cost then to the borrowers. But following the recent management of Treasury bill interest rates by the Central Bank and Treasury, we realized we could accommodate the costs that have gone through and give a reprieve to the customers. And I'm glad that we have been able to avoid this huge jump where interest rates would have gone up by 6 percentage points. We're also managing non-performing loans, and we hope customers will reward us.
In the last few weeks, the government has slowed down its borrowing domestically, resulting in the drastic fall of Treasury bill rates to the single-digit level of 9.6%. While market liquidity conditions have improved, analysts at Cyton Investments remain cautious of government's borrowing of short-term loans to fund the budget, which, as they fall due, may affect borrowing rates. But in the meantime, after the CBK's monetary policy meeting tomorrow announces rate adjustments, it is expected that commercial banks will follow suit and ease the pressure on borrowers. Bella Genga, Monday Special.